Today we are back with the #1 podcast in the world for carbon markets. Today,
Hashtag manifestation, Eddie. I like it.
manifestation, gotta put it out there into the universe.
I love it.
But regardless, it's been a busy week, at the APAC Commodity Conference. So today we have with us our weekly bestie, Rene Velasquez, and then some surprise guests towards the end of the show.
You just gave away the surprise, Eddie, but sure, okay.
Oh.
It's fine, mate.
Well, whatever. Gotta, it's
Spice
still
it up.
it's still spicy. Yeah, so I guess today we're just gonna run through some of the stories of the week and just kind of get some perspectives and opinions on the major developments in the market and see what we could talk about. So, with that being said, one of the big stories was HSBC kicks back climate targets to avoid reliance on offsets. That was the headline on Quantum Commodity Intelligence. And for further details, HSBC has delayed its 2030 climate target by 20 years, blaming the insufficient pace of the global energy transition, which would make the bank too dependent on buying carbon offsets, it said in its annual report published on Wednesday. So this is Europe's largest bank, committed in 2020 to reach net zero carbon emissions in its own operations and supply chain by 2030. And in this report on Wednesday, it said that it is only on track to reach 40% reduction versus the 2019 baseline by the end of this decade. And that means that the bank's scope 1, 2, and 3 emissions from its own operation, which includes business travel, offices, IT infrastructure, would fall to 1.06 million tons of CO2 by 2030. So, the bank also made a statement in its annual report that it has become clear, I quote, "It has become clear that we would need to rely heavily on carbon offsets to achieve net zero in our supply chain by 2030, the bank said in its annual report. This approach would not be aligned with recently updated guidance from the Science Based Targets Initiative, SBTi, on the role of offsets in meeting corporate net zero claims. As such, we have revisited this ambition to take into account latest best practice guidance." Okay, so we've seen this for a long time coming. I think Rene, definitely you've kind of been outspoken about this with corporates, but we've seen this coming. What are your initial reactions to this? And do we think this is a trend that we'll see amongst other big banks and asset managers and corporates in general that are kind of being misguided by SBTi or just kind of confused on the situation with offsets? I mean, we could talk about this for a long
For
time,
hours, Eddie.
for hours.
Yeah.
But yeah,
I'll try to keep it short, sharp, and sweet. This is a failure of leadership. This is capitulation of large banks essentially now cowering because of changes in administration in the United States and the changing winds that have basically shifted against DEI. It is caged or wrapped in this notion around the lack of integrity with regards to the underlying instruments that are carbon markets. That is a topic that has been litigated and has been discussed ad nauseum, and the market has actually been addressing these perceived integrity issues and is doing a remarkable job. But I've got to give attribution here to a friend of the pod and a friend of mine, Rich Gilmore from the Carbon Growth Partners team. It is a lack of integrity, but it is a lack of integrity with regards to maintaining and upholding commitments. I don't want to conflate those two, okay? And I want to make it evident that it is a failure of leadership. In addition, okay, kicking the can down the road for another 2 decades when we have a finite carbon budget just so that it aligns with SBTI shows the perversity of the choices, right? The perversity of the situation, and as a result of the choices, that the exclusion of carbon credits in particular, but other environmental attribute certificates from the SBTI approach has caused. Yes, there may be a reliance on carbon credits in the early stages. Decarbonization is hard. They need a price signal. There's a thing called the marginal abatement cost curve. McKinsey did this analysis back in 2008, I believe. And without a price signal, guess what? The actual hard work of decarbonization is almost impossible. Why? Because it doesn't make financial sense. And so in the absence of paying a penalty for emitting carbon tons, well, it's just the same behavior continues and you just go business as usual. So what this has resulted with is essentially business as usual and kicking the can down the road for another 20 years. Meanwhile, the physics of climate change remain evident to everybody. We have a heating planet, and every single year it is another record, right? And yet we call out the perversity and the hypocrisy and the how horrible it is, the evil upon the world that is now labeled as greenwashing, right? But walking back targets, fine, just another news story. And that is abject hypocrisy. So I'm not pointing my ire at HSBC in particular, because we've seen this across all of the major US banks. They've exited all of the net zero alliances that have all the different acronyms, and you can figure that out. And it is because of they want to cower to the new master in town, right? On that side. And they also realize, and this is, I think, the real reason, the difficulty of decarbonizing the financed emissions, the Scope 3 emissions. It's really good business to continue to do business with large emitters, right? And so these banks are realizing that it's really hard to decarbonize their financed emissions. And now they're just saying, well, no one's going to hold us accountable, so we'll just retreat. We'll just retreat in plain sight. And the media is not having the tantrums that they had around some carbon credits with regards to overcrediting. Like that was a horrendous act on committed against humanity, right? If you saw the number of clicks and impressions. But now something like this, it's just another passing fancy. And that to me is abject hypocrisy. So yeah, it's got my blood boiling. I agree with Rich Gilmore. It is about integrity, and it's an abject failure of leadership. The end.
Yeah, I mean, I think, and I'm going to quote what the bank has said again in another part of the report. It says, "We are limited by and cannot on our own overcome." It says, "We are limited by and cannot on our own overcome the present lag in policy measures and the overall slower pace of the transition. These factors put our customers and our own net zero ambitions at risk," the bank said.
Yeah, I get that. Can we just go back to just the brass tacks here, Eddie, and just tell me again, what was the total Scope 1 and 2 emissions of the bank? Right? Let's just assume for a second that they depended on 100% carbon credits. Let's just have a look at what that number is, and then let's do some back of the envelope maths calculations, please.
1.06 is the goal for 2030.
1.06.
1.06 million, 6 million
let's
tons.
call it 1 million tons, right?
Yeah, 1 million tons.
Okay. At $10 a ton, right? $10 million. Oh, wow. Okay. HSBC Holdings reported total assets of approximately $3 trillion last year. Just let that one sink in, okay? And we're talking about $10 million. Let's pretend now for just a second that they went to the high end of town and purchased, just durable carbon removals, right? Which is a bright spot in our market. And it's fantastic to see CDR doing so well, right? Let's just take an average price of $100 a ton. We're talking $100 million in terms of commitment, right? But that's too painful, and then they would retreat from the market. Failure of leadership. The end. $3 trillion, right, of total assets. And I bank with HSBC, and I've got great relationships with my relationship managers for full disclosure, right? But that's just poor in terms of leadership, right? And because of the policy vacuums that have been created now, it's easy to just run. Okay, it was cool when all the cool kids were doing it, then you unwind it as soon as it gets the first sign of difficulty, right? How can we tolerate that level of hypocrisy given the current climatic urgency. There is no sense of urgency now for a lot of folks. Oh yeah, it's another warmest and hottest year on record. And we just keep looking at the tape, right? It's like the frog that's perpetually just boiling in that water. And it is ridiculous that we allow this to happen. But no one else.
Yeah, I find it the fact that they blame kind of SBTI and just the carbon offset
SBTI
market
just
or
enabled them.
the energy transition. I mean, it's all an excuse at the end of the day. It is an excuse because if you don't
Let's
like
not make SBTI to be the evil guys on this.
If you don't like SBTI,
well-intentioned.
there's no problem. You can still offset your residual emissions, right? If you don't like if you don't like
and you can also impose an internal carbon price, right? So you can now, having an internal price and effectively self-imposed penalty, you can now go up that marginal abatement cost curve and look at how to reduce those emissions. Now, when you look at finance, they don't have a lot of emissions apart from some scope 3, right? Through finance and then travel, and then their operational emissions aren't that significant. You could see a bank that size with 1 million tons is not a lot. Let's contrast that to an airline whose scope 1 emissions are enormous. Delta Airlines, somewhere 30 to 40 million tons a year, give or take, and that's one of the largest or the largest airline in the world, right? And they're not doing $3 trillion worth of business, right? But HSBC is. And they've got a 1 million ton footprint. So relatively very strong balance sheet compared to the actual carbon footprint and carbon that they emit. It changes, however, when you start to look at the finance emissions. And that's what they're worried about. They're worried about the slippery slope argument. They're worried about setting a precedent to be dependent on and supporting climate finance. And then to effectively then realize, oh, we have now basically a conflict with regards to the financing that we're doing. And I'm not singling out HSBC here. I'm talking about the banks. The banks are doing this. We could talk about JP Morgan. We could talk about a number of them, but they're financing a lot of high emitting industries. Why? Because it's profitable and banks need to make the profit. They have shareholders and stakeholders that they have to do that. That's part of their core business. But without actually imposing these and upholding their commitments, then that's greenwashing right there. Right?
Yeah.
That's greenwashing. I don't want to single out individual companies, right? I think my frustration just stems from the fact that this is hypocrisy at play, and we denigrate greenwashing as the ultimate hypocrisy, but companies that are actually retreating from climate targets and pushing back by 20 years, that's abject hypocrisy and a lack and a failure of leadership. And I think it's systemic within finance because of the difficulty of addressing finance emissions. Pure and simple. Okay.
I'm gonna have
to. Hey guys.
Hey, hi, look guys. Who's here. We got a surprise guest.
The team. Hello. How's it going?
Good, man. Thanks for joining us.
So we've got some friends of the pod who have just joined us today, rather spontaneously, I might add. Right there, Eddie?
I'd be remiss not to talk about the story of the week, which was carbon trade, which was, coming out of stealth mode. We've been working on this for a long time. Obviously, we've got the CEO, we've got the head of products, the head of marketing, the head of portfolio management, all on a call together. So I think now would be a good time to, maybe leverage this platform to explain our ambitions and maybe describe the story of how this came about to begin to, make sure our audience understands, what we're doing and why we're doing it.
Right. Eddie, I love it. And I love how you use corporate speak to just mask shameless plug, which is great. But I'll take it from here, man, in terms of answering that question with regards to talking about the story. So yeah, look, it has been a bit of a story. One of my friends said to me, hey, dude, you literally have been dominating my LinkedIn feed. Make it stop, right? It was quite funny, but I'm really proud of the team. We've been working really tirelessly for quite some time now, behind the scenes, to demonstrate and to innovate and effectively demonstrate what we've been thinking about, and it's this challenge the status quo. The genesis of carbon trade came about, and for folks who may be new to the podcast, to kind of give them a bit of background, I spent a decade building out infrastructure, or part of a team building out the infrastructure that underpins the carbon markets today. Had an amazing time at a company called Expansive, and really proud of what we achieved. And Expansive built out the exchange infrastructure, but also registry infrastructures that underpin the market today, innovated around standardized instruments, just did so much and is a core part of the overall ecosystem. So I learned my trade, let's just say, there. When I finished up, actually, no, I'll go back a little bit. So whilst I was at Expansive and the market was really in ascension in 2021, I received a really interesting call. Basically a high net worth individual contacted me via LinkedIn, said, hey, I'd like to have 10, 15 minutes of your time. Are you available? So I took the call and had a chat with this gentleman. And he said, essentially, look, I want to get some exposure to carbon credits. I think it's an interesting asset class and I want to incorporate that as part of my portfolio. And I said, sure. Okay, that's great. What are you looking to invest? And he said, I'm looking to invest $10 million into carbon. How do I go about doing that? And I said, oh, look, do you have a family office? He said, yes. And I said, well, why don't you do it through your family office? He's like, I don't want to. I want this to be sitting on my personal balance sheet. I feel passionate about the climate. I believe that carbon credits provide, a key indicator here and kind of stimulus to provide climate finance. I want to walk the talk. Help me buy $10 million worth of carbon credits. And I said, sure, but there's some difficulty here in terms of how you do it. The registry systems just don't allow for individuals just to turn up and to set up a registry account and to buy credits. So it's not like crypto, you set up a wallet, you get on an exchange, and then you can just start to trade. And he's like, why not? That makes no sense whatsoever. And I said, well, interesting question, but the reality is that the market is predicated on the use case that carbon credits are used as a compensatory mechanism or instrument to offset carbon emissions on a corporate balance sheet. Essentially, carbon emissions accrue as a liability on a corporate balance sheet, scope 1, 2, and 3, and carbon credits are used to compensate for that. And he's like, yeah, that's great. But if they're all buying, then I want to be ahead of that. I want to take a position. I think it's going to perform really well. And he was right. It did perform really well. But the short answer was I couldn't help him out. And I said, look, talk to these folks here. They'll help you to buy it, and then they'll warehouse the credits on their books. And he's like, no, that's not what I want. I want to own it. Give me a digital wallet. And I said, this doesn't work. Anyway, that conversation stuck with me for a while until another entrepreneur called me later down the line and said, hey, I'm thinking of building this platform, essentially the Robinhood equivalent for carbon markets. And when he asked me for my advice, I thought about it, and I'd seen numerous attempts of engaging the retail public, and they all predicated on one failed notion, which was to engage individuals based on guilt assuasion to offset or compensate their emissions. Take airlines. We used to manage some of the airlines' retail programs, and that was embedded in mobile apps for the booking experience of buying a flight ticket, and then also offsetting your emissions. Again, predicated on guilt. And at one point, the guilt machine was working, but it's proven psychologically not to be a consistent drive. And as a result, mechanisms that have tried to embed carbon offsets in transactions, purchasing flights or purchasing goods and services, just haven't had the traction. What this founder and what then our team has really kind of caught on with regards to our core thesis, or I should say, yeah, is driven by this core thesis, is that we need to change that paradigm, and it needs to shift away from guilt assuasion and engage in the fundamental driver of markets. And that is value, and ultimately it's greed. Markets are driven by the risk propensity to make money, but also, accept potential for loss of money, but they're driven by greed. People want to have more return in the future, right? They're willing to speculate and take some risk there. And so anyway, fast forward, I ended up coming in as an angel investor, and then I finished up at Expansive, and essentially, I then asked the founder, Jonathan, I said, who's going to be running the company? And he said, I was hoping you could. So for the last year and a bit, I've been working in sort of stealth with U3 to try to build this idea. And so that's a long story, but effectively, we've been working to build out a platform with a mission that is very simple: to democratize carbon markets. Why? Because we believe that participation, right, in this market is actually beneficial for liquidity, and that we have an opportunity to reduce the barriers of entry and to enable participation so that a broader subset of actors can actually engage in this market to drive and create a price signal to channel finance where it can actually deliver impact at lowest cost, okay, and deliver that impact in the form of reducing and or removing emissions from the atmosphere. And also to challenge the status quo that carbon credits are only an instrument to compensate the liabilities that are accruing on balance sheets, because either that's driven through voluntary commitments, which again are altruistic, right, and are not sticky enough, or they're driven by policy, which makes it mandated and makes it basically, you know, compliance. So we think that carbon credits are really fungible ultimately and can stand on their own 2 feet as an asset class. And so what we're doing is we're innovating in and around that. We're coming out of stealth, or we've come out of stealth with this platform. We've built a minimum viable product, and it is a mobile phone app available on Android and on iOS in order to be distributed to as many possible users when we do launch, to enable them to buy, to sell, and ultimately to retire carbon credits. And that last bit, the retirement piece, that's what makes carbon credits different from other assets, right? Where you can buy and you can sell them, hence the trading component. But carbon credits can be used to compensate for emissions should people want to use them, right? We don't want to take that away from them. That's an inherent feature, but we do want to enable more and more liquidity. And so this drive, or this kind of journey that we're on, is in order to build out the platforms that can ultimately change this paradigm. And we want to not only, well, we're beginning with potential for retail, but it could be any investors, right? That could be individuals at the low end of the financial pyramid, high net worth investors, family offices, philanthropic organizations that want to engage, any member of civil society, as well as enterprise, that big end of town, large MNCs, or small and medium enterprises, SMEs, or other investors, institutional or other forms, right, who want to engage in this market. And so what we hope to do is to effectively provide all of the benefits that exchanges have done at the institutional and enterprise level, but now to open that up to a much broader and more democratic demographic. So that's really kind of the notion here. I'd love to get you guys involved and talk about it, you know, in terms of what got you guys involved into this mission, and what you guys are proud about, and also what you hope to see over the years ahead as we continue to build out the platforms.
Yeah, so I think you touched on 2 very key points that were, you know, kind of how I wanted to enter these markets as well. One being, you know, the obvious, which is the barrier to entry, right? Coming from a background in finance, I was obviously interested in understanding the use case of these instruments and also understand the viability of these investments. And as a retail investor with, you know, a slightly higher propensity to risk, or being able to diversify your own personal investment, carbon credits sounded like a very interesting opportunity, but you know, there's no access to it, right? And I think that's been the biggest motivator for me to join this mission. If you think about it, you know, most of these financial instruments or markets are obviously, you know, going to be driven by greed, with the inherent need to make money, right? All of us want to make more money. That's why we're willing to take the risk. If you're going to put, you know, if you switch the cart ahead of the carrot and then expect it to run in a, you know, seamless manner, that's never going to happen. And I think that was one of the issues that I saw as an outsider looking in to carbon markets, right? Very few instances of markets exist where there is a lot of regulation initially, and following that comes liquidity, right? Because it's the other way around. We look at Bitcoin, we look at any other financial instruments, it's always been more, you know, innovative, more propensity for risk, but the regulation comes after there is some structure in the industry. But in carbon markets, it was the other way around, because obviously, you know, the retirement aspect, like you said, Rene, right? Talking about the liability on the corporate side, and then looking to, you know, indulge in these carbon markets as an offset mechanism. So while that existed, it did make sense for a set of investors to be able to take positions and kind of, enjoy the benefits or the hockey stick that might be seen in the long run. And that was the main motivating factor for me to, even get into this industry and learn more. And while I had that conversation with you, I also realized that, you've been thinking about it for quite some time. And all the points that you mentioned were things that all of us as, newbie investors or, semi-professional investors look for, right? If there is an investable asset class, we want to look to, dip our feet in it and get some kind of exposure. And I think the retail market has been largely ignored in this space. And the mission of Carbon Trade, which was to democratize all investors and enable participation across, SMEs and individuals and larger corporates as well. That was a strong mission, and that's what drove me to our project. And I'm happy to be involved and work on it with you guys.
Thanks, Akash. Really appreciate that. And for context, like what we saw, right, that hockey stick in 2020 and 21, I believe 21, carbon was the best performing asset class in the world. So an 800% appreciation year
Wow.
in that year. And that was relative to the benchmarks, right? There was even more significant growth in that asset class based on, well, different entries, but there were arbitrage opportunities therein with regards to the geo contract, and now kind of talking really inside baseball, which was the first standardized instrument for the market. There were projects that would be deliverable if they had an additional document, right? The SDG contributions report in the early days. And so there were project developers and traders who were then looking for those early stage projects, effectively buying them up at a discount to where the benchmark was, waiting, holding until he got the paperwork, and then delivering it into the contract. And as effectively the market dynamics went in their favor, that contract actually grew very, very aggressively and very significantly over a very short period of time. And their entry point was actually lower than that. It got up to $8, and this is kind of tracking the performance of that asset from a $1 price to about $8 a ton. But there are folks that got in much, much less. So it did perform well. And that's, I think, the impetus of why that original person called me to say, I wanted exposure to this, because he saw effectively the directional play here. I do want to say one thing, and I want to challenge it, and then I want to kind of just go to Olaf. This is innovation. It's not inventing, right? And there's a slight difference. There have been instances, and the market got really, really burnt as a result of these, with people that had ill intentions marketing carbon credits to uninformed investors. And I'm risking my reputation by putting it behind this, along with you guys and with our board, to build a system that is abjectly a transparent and level playing field for all investors, right? We want to provide information to reduce the asymmetry, and certainly we provide a curation akin to portfolio management, right? Essentially curating portfolios to ensure that quality is a key component of it, right? And that there aren't any unfavorable assets in those baskets, right? That's a key component. And the reason why is that we've seen that fail before. We saw it, unfortunately, with ClimaDAO, right? ClimaDAO was really the perfect confluence and inspiration for something like this, where we saw participation and the appetite from a broad range of investors entering into a crypto parallel universe predicated on underlying assets from carbon. But there was no stringency with regards to the curation of what was deliverable into that DAO, which is effectively like a contract. It was just a black hole where a whole bunch of credits got thrown in, and then they would tokenize it and then let that run. We've thought long and hard about this to differentiate this approach, and we really want to take lessons from financial markets, in particular what ETFs have done, and kind of the evolution of financial markets. So we're doing it very slowly and very deliberately, because we want to make sure that this is correct. And this is why, again, we launched with a beta test and not with the final product, even though the minimum viable product is ready to plug and play via an API to the registry ecosystems. And on the cash wallet side, the wallet is ready to plug into banks, but we're not turning those on until we're ready and really to rock effectively. And we've got the blessings also from regulators, because it's really important around how this asset class is treated. For most jurisdictions, it's treated as a commodity and therefore not under the purview of a securities commission. But there are instances where regulators are looking at it, whether it's a security. We want to have thoughtful and engaging dialogue with those regulators, as opposed to disrupting and creating kind of a big mess and then hoping for the regulatory kind of capture to come in later on. Slow and steady. We want to be very deliberate, and I said, as I said before, putting our reputation at stake here to get it right.
Absolutely.
Olaf, I'd love to hear
Well said.
your thoughts on this, because you've been instrumental, along with each member here on the call, in basically realizing the vision, right? Akash and I, early stage, were effectively doing the engineering component, let's just call it, right? Bringing this thing to Notion, technical expertise, etc. And when you joined us, you then were able to take that vision and effectively crystallize that, and then help us, most importantly, communicate it to a broader audience. I think the reception that we've received this past week is a testament to your input, really. And I want to give you flowers, as with Akash, right, and Eddie for the contributions. So just tell us about your perspective in terms of motivation, Olaf, to kind of sign up to the mission, and then kind of, you know, how you see the mission and the vision extended over time.
Yeah. So first of all, thank you guys for inviting us to the podcast. I think my motivation is quite simple. Yeah. So during my master's degree, I've joined Rene on another project, which is called the Carbon Exposure Project, the podcast where we were doing for the past more than a year already. And I didn't, before that, I didn't know anything. Yeah, exactly. Before that, I didn't know anything about the carbon markets, to be fair. But in that time, basically you talked with many visionaries, market leaders, and it truly inspired me. As I said before that, I didn't know anything about the carbon markets at all, but it really convinced me of the effect that it can have on combating climate change. And I think, you were talking about that hockey stick that occurred in 2020, 2021. I think that was a sign that many people also believed in this market. It has been a very, very good market at the time. But when I kind of got into this space, I think that all declined a little bit. So now,
significantly, Olaf, you came in 2023. And you started to see the other side of the market, right? This kind of downward trend that was pretty steep in 23. 24 was also lean, but it wasn't as lean. And I'm referencing only the voluntary carbon market component. Compliance markets continue to chug along in there. And then now you have compliance systems now covering 25% of the world's GDP. But you know, most of the kind of this time that we spend is speaking to voluntary buyers. And the sentiment was fairly anemic. That was really the impetus and for the drive for us to set up the Carbon Exposure Project. You were there from the start, and have helped me sort of, again, crystallize that vision around distributing content that is positive and engaging and thoughtful, and showcasing the people that are dedicating their lives day in, day out, and are building things, as opposed to the folks that are trying to break it down from the outside.
Yeah. So that was kind of strange for me, because on the one hand, I got really excited and inspired by you and the guests we were having and about the carbon markets. And on the other hand, I saw the market declining. So, I think for the past few years, the market has been illiquid and also, inaccessible. And that also means that it has been dominated by a few like large corporates. And I think the mission of carbon trade, by democratizing the carbon markets, by making it accessible to everyone, is something for me that can really help to like grow this market again. And I think that is my biggest motivation. I've seen the potential of the market. I really think that the market can be one of the solutions in combating climate change. but it hasn't reached its full potential yet. And if we can achieve that with carbon trade, if we can drive liquidity to the market, if we can let new entrants join the market, then I think, yeah, we did our bit in bringing back the market to its full potential. And yeah, also our bit in combating climate change. So I think that is my biggest motivation. And of course, to work with such a nice team with you guys, that's also a very big motivation for me, guys.
Yeah, we have a lot of fun. I think that's a common theme, right? Like, just if you're having fun and you're building things with cool people, it's not work anymore, right? There's this old adage: do the things you love. The other bit is try to focus on providing solutions to the problems that really, that you really focus on, right? Like that really reach into your heart and soul. And for me, carbon markets are a very eloquent solution to a very complex problem. They're nuanced, but they are really powerful when used correctly and when leveraged correctly, right? And that's ultimately what we want to do. But yeah, we're having so much fun, and that's just so great.
Yeah, very well said, guys. And I think you have an opportunity to build a great business in a market downturn, right? And given the market is at an inflection point, I think that's where we saw the opportunity to take advantage and try and build something that's really valuable for the world, right? And I think, in a way, Bitcoin and cryptocurrencies do correlate to the carbon markets, specifically in with carbon credits. And I think, Rene, you have a good perspective on this. If you'd like to jump in here and talk about how the rapid growth that was facilitated by blockchain platforms like Ethereum, and digital tokens for non-fungible tokens, and all of that correlates to the carbon market, and how that correlates with in a way what we're building with carbon trade.
Yeah, thanks, Eddie. Look, I look to crypto markets, and look, I'm a Gen X baby, so it's your generation, the millennials and the Gen Zs, who are really heavily skewed towards participating in these emerging asset classes like cryptocurrencies, DeFi, and NFTs. But I think it has a lot of parallels with regards to carbon credits. A nascent asset class, it delivers value and is in search of greater liquidity. And I think that, when I look at crypto, I think it's like 16, 17,000 distinct cryptocurrencies are in existence. And that I think might include NFTs or something like that, but it is a really large marketplace, valued somewhere in the 3 trillion market sort of cap range. Let's contrast that with carbon markets. It's 1/3 of it, around roughly $1 trillion, with a very large percentage of that being dominated by the European emissions trading system. So I think that carbon has that potential to scale. I think that we're learning those mistakes, but we've been super self-chastising as an industry that, okay, it's not perfect. We need to rip it all up and start again. No, the integrity components and integrity fears have been addressed. They're continuously being addressed and will continue to evolve. But what I think that we're ready for is this continuous evolution of the market size and scale by reaching a broader demographic. When you look at equity markets, and I kind of wanted to bring it back to that, and we're talking about Robinhood, we're talking about ETFs. I was just looking up some stats earlier. In the United States, as of 24, roughly 62% of adults have investments in the stock market, right? And retail investors account for, I think it's 1/3 of total equity volume, right, over the last few years. And we've seen that they've actually been active in moving stocks. We saw that whole meme stock fiasco a few years back during the pandemic when people had a lot of time, and that was interesting. But they actually challenged the supremacy of a lot of the incumbents, right? The hedge funds and other sophisticated traders. And that, to me, is a really interesting shifting paradigm around the power that this distributed demographic has. When we look at the same sort of numbers or the same sort of statistics within crypto, I think it's like 15 to 20% of individuals have traded crypto globally, like in terms of adults. So it's still got a long way to go. So that market has potentially a significant more upside with regards to growth. Obviously, equity trading has been around for hundreds of years, and particularly the last 100 years in the United States has been very, very strong following the Depression in terms of that participation as a capital markets vehicle. And I just think carbon markets is at this inflection point. And I think we have an obligation as proponents in this market. And I look to folks like myself and all of the people that have built the market before, currently building it, and the folks that will build it after we're gone, i.e. your generation. We have an obligation, the collective we, to innovate and build new products and bring new ideas to the forefront and be unafraid to fail. We see that in technology where innovation abounds. Capital is freely available because there's been proven over and over and over again that technology provides incredible leverage and is beneficial to society in so many ways. Finance does the exact same thing, and I believe that carbon markets provide that nascent asset class with a lot of potential for growth. And I think the reason for that is that it is ubiquitous. Carbon is across every single industry in the world, right? Like money, it is on every single industry, right? And what we're trying to do is put a price on emissions and reduce those so that our species has a more habitable planet rather than a very hot and not very enjoyable one. Right, I don't lean into the climate doomism, but you look at the 6 historical extinction events, and many of them, in fact, all of them were led by huge spikes in CO2. And right now, I think that we recognize that because we listen to the science and we look at the physics of climate change and we see the planet heating. And your generation is the beneficiaries of the world that we're leaving behind, right? Have now an obligation to think about how to solve for these problems through innovative solutions. We're putting out just one. And I challenge anybody that's listening to think about the problems and figure out solutions of how they can leverage their experience, their network, their influence to actually come up with better ideas. And if it fails, guess what? It's okay. You took a risk, and that's what capital markets are. That's what being an entrepreneur is. And I encourage people to do that. You can learn along the way, and you can iterate, and you can improve, and you can manage out those risks. And that's the journey. And I think that I've learned from great entrepreneurs in my background and through my career, and I'm now accepting the torch and challenge to go and try to build something exciting. And that's what we're doing here.
Yeah, very,
Absolutely.
very well said, Rene. And I think, kind of diving further into the specifics of carbon trade, right? And taking a step away from the macro picture.
Just
you wanna hop
before
in?
that, Teddy, I just want to touch on one point that Rene mentioned, right? Which is, I think, the parallels between carbon markets and crypto, right? I think that's a very interesting point because there have been very few instances in financial markets history where, retail participants have been ahead of the curve even before institutional participants, right? Bitcoin was one such scenario. And Rene also mentioned, the meme stocks, the GameStop scenario. That was one other small instance where we saw retail participants kind of, take the flag and, just show the finger to institutional investors. And I believe that carbon markets can be one such investment class, where retail participants can actually get ahead of the curve. Take your time, because all numbers, all indicators show that, institutionals have nowhere else to go because there's no better solution. And corner the market, get your bit in carbon trade, and then just wait it out. You won't.
Spoken like a true Gen Z. No, but I love it because you said something, Akash. Look, we're not going to give investment advice, but I do think that there's an opportunity here, given the fact that liabilities are accruing on balance sheets and are being kicked down further down the road. That means that they'll have to pay the Pied Piper eventually, right? There's inevitability around carbon pricing, whether that's compliance driven, most likely, or via voluntary means, and really being driven by a social license to operate. So that's the thesis. So we do believe in the long-term growth of this as an asset class, but without the requisite tools, this thing doesn't actually scale, right? It can actually be suffocated with fairly little oxygen as a result. And I think that's what's been happening in the past 2 years. And I think, given the passion that I have for this market, is to just try to bring that forward. So that's that.
Yeah, definitely. And I think maybe on a kind of final note, users signed up to the platform so I just want to ask, what can users expect when they get into the Carbon Trade app for the first time, right? And what is the ultimate goal of this beta test, right? And I think it'd be really great to hear your thoughts and opinions on that we can explain to the audience how critical their feedback is and how they're going to help build this into a viable solution, right?
Yeah, I think Olaf, you can start off with the marketing piece, probably.
Yeah. So yeah, the reception has been really, really good so far. So for the audience, for the listeners who already signed up to the waiting list, thank you so much. Yeah, what they can expect, I think. So first of all, the beta test will start March 5th. And what they can expect is just a nicely working app in which they can like get the feeling of trading carbon credits, retiring carbon credits, buying carbon credits, and see how that works seamlessly and how easy that can be. They won't be trading with their own real money. It is all fictitious money. They get a wallet, but they will be free to make any trades with our three expertly curated portfolios, basically. And yeah, I think the real goal is to get as much feedback of you guys as possible. I mean, with the feedback that you give, we can like improve, develop, and eventually create a almost to perfect retail app that we can leverage to bring more liquidity to the markets.
Yeah, I think you touched on a lot of those points, Olaf. While we're starting off with 3 expertly curated portfolios that are available to trade within the app, obviously, this is just for a beta test page, right? What we'll be doing is our product line is expandable. It can hold as many as however many participants want to come in and sell a curated portfolio from their end, right? And while we're doing that, I think the app itself, we've tried to make it as intuitive as possible from a user experience standpoint. We want all the participants to really, actually go through the app with a fine-tooth comb. Please give us feedback on all points and all places where you might have any issues at all. We'll be running this for probably a 30-day period where the prices are updated on a daily basis. And while we're doing that, we also want to ensure that everything runs smoothly. We're very excited. The entire objective of this beta test is to collect feedback. Reid Hoffman said that if you're not embarrassed with your first product out there, you're already too late to launch. And while we're not embarrassed, we're really proud. I'd also like to believe that, we've been quick to come up with solutions and actually have an MVP. And that's what we're trying to achieve through this beta testing. Get as many participants as possible. Obviously, we have, a fixed number, and the wait list is, it's almost, we'll be closing it soon. So we want as many participants and as much feedback as possible. And we'll take it from there.
Yeah, you need to be uncomfortable when building technology. The reality is, if you think, if you resist actually going to market and you for too long, you're just in an echo chamber and a silo. So we've been basically toiling away in the shadows building this thing. It is now time to gauge input from our intended users. We are firstly launching this within and through our LinkedIn sort of professional networks to the professionals who live and breathe these markets. It was interesting. Eddie and I were at a commodity trading conference this week, and one of the panels that I was on, the moderator actually asked, because he was talking about financial markets and derivatives and the kind of intersection with carbon, and he said, "How many people here have traded, different asset classes?" He said, "How many of you guys trade carbon?" Everyone put their hand up. How many of you traded carbon for your company? Hand up. But what about its individuals? And 80-90% of the hands went down. How many of you have purchased carbon credits to offset your emissions? Yeah, sure. How many of you have actually invested in carbon credits? So like, yeah, I think it was like 3 or 4 people in the audience. And I was just like, yeah, this is kind of the thesis here. There's an opportunity of a total addressable market that hasn't yet been addressed because there hasn't been a value proposition that has been clearly communicated to the broader masses. But back to the app, we are not arrogant enough to think that we're going to get it right the first time at bat. I'm going to acknowledge the fact that the app is by no means perfect. It is intuitive. We think we spent time building the intuition and that user interface component to it so that it can resonate and it can be slick, let's say, in terms of how to use it. We really need a lot of input on the product side to gauge from experts what are we getting right, what are we getting wrong. Our board and I really spent some time thinking about the types of portfolios that would be innovative and that people may like, but we're really open to those different ideas. And as you said, Akash, essentially we start off with curated portfolios. There's an infinite expandable universe after that for other professional market managers to bring their own funds for upvoted concepts from the community and even leveraging machine learning and AI, right, over time. And these are all things that we're thinking about. And I would just say to folks that have signed up, and again, really, really pleasantly surprised and grateful for the interest. I want to reiterate to folks listening, we have a limited cap of how many users we can accept. We made a decision to extend it a little bit more, just given the feedback that we've received, which has been overwhelming. But I don't want to drown the team in responses and passwords and all the sorts of things that go along with providing access to a platform. Yeah, so that's what I'd say there. Eddie, why don't we want to hand it back to you? And I think let's kind of stop the grandiose self-promotion.
Yeah, definitely. I mean, I think we've touched on a lot today. It's been an insightful conversation, but and it's exciting to think about how this will evolve and the impact it will have, not just on markets, but on real climate action, right? And I think if I leave, one last question with you guys, if you want the listeners to take away just one key message from the conversation that we've had and about our purpose moving forward, what would you want it to be? And I think
that's a very interesting question. I think the key takeaway from my end, I think we've been very intentional with what we've created. Again, to repeat what Rene said, we don't want to be tooting our own horn, but I think the key takeaway from this would be that we want feedback, we want participation, we really want to see this market grow. We really want a successful solution to be available for all participants, right? And we believe that this solution is eloquent enough and we need feedback. So, I hope that people who end up participating in the beta test actually see what we have to offer and give us feedback that we can constructively work on.
I mean, Rene, did you want to answer this question or this last question for the
yeah, sure. I mean, look, I think I've talked too much about this at this point in time. But look, yeah, what we're trying to do is just innovate, and innovation sometimes is messy, but it can be fun. And what we're doing is essentially providing an opportunity for folks to visualize and now effectively influence the development of a tool that will provide, hopefully very soon, access to the carbon markets and enable that broader participation. And if you believe that carbon can become a viable asset class, then we want your input. That's it.
Mm-hmm. Yep.
Yeah.
That's it.
Great. Well said. Olaf, what do you think?
Yeah, I think Akash touched upon the key message. I think maybe where I want to end with before you going to the next news topics of this week. Maybe a small call to action to everyone who's listening. We will be uploading a bunch more on our LinkedIn for the coming weeks before the actual beta test starts. So please follow our LinkedIn. We also have socials, Twitter and Instagram. They all go by the name crbn.trade. And yeah, we have some more surprises coming up for you. You can actually, the people who will be helping us to gather as much feedback as possible will be or maybe rewarded with a prize, but you will hear more about that soon. So yeah, thank you guys.
So,
All right. Well, segueing back. Oh,
Eddie, one final thing. You didn't really talk about your mission and vision and the reason behind joining Carbon Trade. So I really wanted to know that.
Good on
Yeah.
Akash.
yeah, definitely. I mean, look, yeah, when I
He's
came
doing
into,
he's doing double duty of the moderator as well. You see, Akash.
yeah,
No,
yeah,
I just realized that he hadn't covered, and I was naturally curious. So yeah.
Yeah, me
no,
too.
definitely. I mean, I think I've always been very passionate about entrepreneurship and innovation, and I think this, when I was presented with the opportunity to join the team and to build out something really special in the market, something that the market needed, I definitely, you know, wanted to take that chance and take that opportunity because you don't really get those opportunities every day, and it's something that I didn't want to look back on when I'm older and say, "Oh, I wish I would have done that and taken that risk." Right? I think that's the worst thing you can have is regret. So that's one aspect is just I've always admired entrepreneurs and startup founders, and it's really tough. I think doing tough things and building out a startup is super challenging, right? And that's what that's what makes it very unique, and I think that's what builds people up to become great entrepreneurs and founders, and they push the forefront of humanity and society, right? And I think also the fact that there was no there's I saw the market opportunity for this as well from more of a capitalistic point of view. I think there's a big opportunity to build out kind of a Robin Hood for the carbon markets, given the state of the market, building out a company in a downturn was another driver as well. But also, I think it's about the team as well. I think I really enjoy working with Rene, and I enjoy working with you guys, Akash and Olaf, and to be a part of a new company building out something new in a space that's super critical for the world. That's I think in 2025, if you're not building a company that's in the best interest of society, then you're not going to be as valuable in the long run, right? And I think that really holds to be true in today's age. So yeah, that's where I came from.
That was awesome. Let's go back to our regular programming so we don't get too soppy. But I fucking love you guys. It's awesome.
Awesome.
Eddie, bring us back on track, my friend. Let's get these guys. I know that they've got other things to do as well, but why don't you hit us with one of the stories of the week, and then I know these guys have to jump off.
Yeah, I mean, I think something that was really interesting and caught my eye was that Gen Zero and Mizuho Bank had partnered to generate transition credits, right? And then so these transition credits are through the phase out of coal-fired power plants and the replacement with renewable energy. So the partner said that the intention is to generate, greater awareness of this new type of offset with several methodologies under development, and to build, critical mass of stakeholders in Japan and Singapore who want to support this concept. So I think Japan's technological capabilities and their commitment to climate goals makes it an essential market for advancing Asia's decarbonization agenda, right? And that's something that Gen Zero has said as well, and that's one of the reasons why they've gotten into this partnership. So I think that's an interesting topic. Any thoughts on transition credits, Rene, and just
Yeah.
the phase out of coal-fired power plants and the replacement of renewable energy and these types of, we've seen plastic credits, we're seeing a lot of types of offsets being created and innovated to support decarbonization initiatives.
Yeah. Happy to. I think you, in your introduction, I think you really nailed it. So I'll give a little bit of some context in terms of how this came about. But look, Singapore has established itself as a carbon hub, really preeminent one, arguably, and I've obviously got a vested interest living here, but as the number one hub globally. It shouldn't come as a surprise then that the financial regulator here has been playing an active role in helping to stimulate this and specifically the transition credit. So how it came about is that the Monetary Authority of Singapore and McKinsey effectively commissioned a working paper a little while back. And it was a very deliberate approach in terms of how they did that. They had the concept and then they engaged with market proponents and experts. I was very privileged to be part of that, along with many others, and they engage all the different stakeholders across standards, across trading houses, in particular financials, and this is kind of a nice dovetail, Eddie, because it's a bookended, right? We started off with a pretty annoying story around financials retreating, but this is a really good story about financials seizing an opportunity and doing the work. So anyway, the way that transition credits work is essentially addressing a clear issue here within the region in particular. And for context, when we look at the coal-fired power plants in the world and coal electricity generation from coal, when you look at those plants in global north, let's say in Europe and in the United States, many of those assets were built 30 to 40 years ago, right? So they're towards or at already or beyond, even in many instances, the end of that life cycle for that asset. Whereas when we look at it here in the Asian context, let's look at ASEAN, let's look at China, and let's look at the broader sort of Asian cluster. Far newer fleets, far newer assets, closer to 10 to 15 years. And so they actually have a much longer life cycle ahead of them. If we stay on course to consume and burn coal to generate electricity as that baseload electricity in the region, we risk emitting, I think it's 8 to 10 gigatons, per annum. It's an incredible amount of emissions. So here's essentially an opportunity to leverage finance to help to accelerate a transition, right? And so by early decommissioning of this asset, you can effectively switch and accelerate that transition essentially towards cleaner, greener forms of electricity. So it's a fairly complicated process, but I'll try to describe it in as few words as possible, and obviously encourage folks to read the working paper because it is really detailed. But effectively, if you can create financial incentives to the asset managers, the owners of that asset, I should say, then they may be willing to sacrifice effectively a cash generation machine. You put coal in the front end, it spits out electricity on the back end, and you collect money from the sale of the electricity. It's a pretty direct sort of form of generation of cash. Those asset owners need to be convinced that these plants need to be transitioned away. So you need to have a replacement load of electricity in the form of clean electricity, primarily renewables. That is competitive financially, and an investor and financials can actually help to facilitate and stand that up. We see growth of renewables and we see voracious appetite for energy in this region, but also globally, especially now driven by AI. So now if you want to switch off a form of electricity generation in the form of coal because of the emissions component, and you want to replace it with renewables, you need to scale that renewables deployment. But renewables tend to be intermittent, right? Because of sun for the solar and wind for the wind turbines. And so you need to also couple that with storage. So if you can overcome those hurdles, then you have a viable kind of proposition to transition that. But there is a chasm in between, right? How do you move that forward? And the genius of this concept is essentially by leveraging carbon markets. The additionality is met by the early phase out of these assets. And so you can actually start to ramp down the actual consumption of coal of these plants, and then ultimately building up in parallel the replacement base loads, thereby avoiding the CO2 from entering the atmosphere, right? And the permanence is ensured or assured by the governments that say, we will not be giving any new permits to build coal-fired power plants in the region. So you have this multi-stakeholder engagement between private sector, public sector, and financial intermediaries essentially coming in to provide this financial tool. What's been missing is that, okay, where do we sell these credits to, right? The voluntary market can't mop up that amount of demand, right? These are big gargantuan problems. And so what they needed was essentially a bridge into international compliance systems. So because the government's a part of this, there's an opportunity here to generate Article 6 units. Effectively, countries could say, we're transitioning away from coal, and for that, we will be able to export these emission reductions as ITMOs out of our nationally determined contributions, of our budget, right? And in line with their NDCs, I should say. So it's a pretty interesting concept. There's been a lot of really great think tanks and just thought leaders working in and around this space. And it's really great to see now, financials stepping up to the plate. And then back to the Singapore connection, Gen Zero really has been making a lot of news lately. They were formed by Temasek in 22 in order to, with this goal to accelerate global decarbonization efforts. And effectively, they're managing money on behalf of Temasek. I think they're managing somewhere north of $5 billion, and they've been making investments in technology-based solutions, nature-based solutions, and these kind of carbon ecosystem enablers. This is such an example. And like all finance, you get small pools of money. 5 billion seems like a large pool of money, but it's not in the grand scheme of things. And then you compare that with much larger markets like those that banks operate in, right? So fixed income and others, and you can actually get and provide leverage. So for context, I think Mizuho's like, what is it? Almost $2 trillion of assets, right? That they're managing. So really large base. And obviously Japan's been a very strong economy for the past half century and more. And so it's really great to see that those big institutions are playing that role as institutional investors. So cool, great news story is what I'd say in summary.
Yeah, definitely. It seems like the APAC region is really taking the lead on, carbon finance and the carbon markets. And given that, most of the world's, I wouldn't say most, but a lot of the world's natural carbon sinks are in Asia. In the long run, I think this market is going to thrive out of Singapore being a central hub, right? So yeah, definitely a great story.
Akash, last words before you guys have to jump.
Yeah, I know. We have to jump. We're busy building an app. Olaf and I, we're very busy people.
Yeah.
But I think it was very interesting, what you had to say. Again, talking about the incentive, right? We have to incentivize people in order to shift. Like if coal is cheaper and I'm running a business, like what incentive will I have to shift, unless you give me something alternative. So I think it's a very interesting point.
You hit the nail right on the head there, Akash. The other component is that looming compliance costs make those assets effectively stranded, right? So yes, right now you're generating cash for generating that electricity by burning coal, but in the 2030s, most of those asset managers know that compliance will start to bite, and the equation is now how much money they're generating from the sale of those for that baseload electricity. And if there's greater competition from different sources like renewables that continues to compress those margins, input costs, let's say, remain static, right? Maybe, there's up and downs, the commodity market, and coal trades higher or lower depending, but let's just assume that it's static. But now the moment that you start introducing a carbon price, and that carbon price has the direction up and to the right, that really compresses the margins on those businesses and makes them potentially unviable. So those asset managers are now willing partners to engage in those conversations and work collectively with governments to effectively take care of their like LPs in the case of private equity or others, but certainly their investors to phase out that gradual transition of that asset, and then also not be too disruptive. And then the final component that I didn't mention is obviously working with the local communities. The coal pits and coal plants, let's not ignore them in terms of viable opportunities for promoting and providing employment to a lot of disenfranchised communities. And so, you need to have a transition that is manageable and that is equitable as well. So it's a multi-layered complex problem, but again, eloquence of a potential solution. I think it's an ingredient that was missing. And now what we need to do is focus on building the demand. If we can now focus on global and then regional systems that provide that demand signal for those types of credits and other types of credits under this Article 6 framework, then we can actually start to see the energy transition take hold in action and in real time, as opposed to denigrating clean versus dirty and ideology basically ruling the direction, because that doesn't work. We need to work in the real world, and real world is driven by financial decisions and financial investment decisions and risk lenses, etc. And it's multi-layered and complex, and this is just a perfect example.
Yeah, very well said. Very well said. Well, look, I want to thank Akash and Olaf for coming on the pod today. It was great to have you guys on and
No,
hear
thanks so much for having us on. I think, I had a blast, and I can, yeah, this was a lot of fun. So
cool. You guys are welcome anytime. Just drop in. You guys have the link.
For sure.
Although I see Eddie cringing in the background because he's thinking, hold on a minute, I run a pretty tight ship here and I have an agenda. So I may have to retract that after. Let's take that one offline.
Yeah.
Sorry, Eddie.
Yeah, we'll see.
Yeah.
We'll see. Good stuff.
Yeah,
Thanks, Olaf.
thank you, guys.
Yeah,
Thank you, guys.
Appreciate you guys.
Thanks a lot, guys.
Talk soon.
Yeah.
Talk soon. Bye-bye.
Cheers. Bye, guys.
Thank you.
Eddie,
See ya.
last story of the week, because I also have to wrap up pretty soon. I think you do too. We're fast approaching, I think, an hour and a bit of recording time. Hit me with the last question, man.
Yeah, I mean, we saw BlackRock halt down talks with companies after an SEC crackdown on environmental social governance. So under the SEC's new rules, investors seeking to influence corporate behavior on issues such as environmental policies will be required to complete a so-called 13D filing, something which has traditionally been reserved for activist investors such as hedge funds. But a senior analyst at Bloomberg said that efforts are underway to limit the ability of large passive funds like BlackRock and Vanguard to vote on proxies and engage with companies related to ESG issues. So, BlackRock, the world's largest money manager, has put on hold stewardship conversations with portfolio companies following new guidance from the U.S. Securities and Exchange Commission. Yeah, so I think with that being said, it's been interesting to see the landscape shift ever since this new administration has come into office, right? It certainly seems that Wall Street has been, one year their values are this, and then the next year their values suddenly change, and that's
Eddie,
just the way it has
that's
been.
just history.
Yeah, that's just the way history repeats itself.
History repeats itself, and we see this occurring all the time in politics. And for those old enough, we've seen this play itself out. What I would say is, and again, I think something I mentioned in one, I think our first episode, but there's a lot of contention and just kind of doomism around the changes and the speed at which they're occurring, and it's hard for a lot of people to stay positive. One of the impetuses for this podcast is to challenge that notion again. I'm a contrarian, I want to be positive, and I believe that the world is ultimately a very good place. What this example, and also I'll bring it back to the story, shows is that, look, essentially regulators and have sort of changed their position based on the prevailing winds politically. It's good to see the SEC essentially taking some of the stances that they have recently in terms of more favorable market consultations and approaches. I think certainly that's evident within the crypto world, where that was fairly punitive following the FTX situation and that former administration under the SEC. The new ones obviously trying to stamp their own direction. And I think asset managers like BlackRock and others really got that memo early on. And that's why I think that coming back to the first story of the week, where we see this exit of financials exiting a lot of these net zero alliances. This story is essentially much in the same. Essentially, now you're introducing regulatory red tape to suppress activism in and amongst large asset managers. The SEC is not saying, to be clear, that there should not be activist investors. There are clearly ways via this 13D filing for activist investors to remain, but that these folks that are essentially much larger and passive in that they need to go back to being passive. And I think that this is a reaction to some perceived significant influence that Larry Fink and BlackRock exercise in 2020 with his letter that goes out annually. He talked about the importance of climate change. He talked about the importance of pricing carbon, and that was really stimulatory. We also had that perfect confluence then with civil society, the Greta Thunberg effect effectively coming in, and essentially everybody pointing to the same direction. This is now, unfortunately, saying to financial markets, we're not going to be activists on and through proxy votes make or exert undue influence as it relates to DEI more broadly. Sustainability is within that broader context, right? Whether it's DEI or ESG, the sustainability is the S piece in the ESG, and carbon pricing, for better or worse, is part of the sustainability narrative. I think that what this is a reversion back to the mean around financial markets and letting financial markets dictate the direction. I think that's why I'm pushing so much in kind of the daily work and in kind of my sound bites and other conversations that I have one-on-one with people around the maturity of this new asset class, so that it can play in the same sandbox as other assets in a mature market effectively. So look, it's not a great news story, but it is what it is. Love to hear your thoughts on it, Eddie. You're on mute.
Yeah, well, I mean, I think I touched on, my thoughts a bit about the political backdrop kind of changes some of the values on the street, but it's nothing that we haven't seen before, right? I think the market kind of goes in a roller coaster of emotions, right? And who knows? I think as politicians begin to exit the U.S. landscape, and we start to see the next generation come in, I think it'll be a lot more prevalent with environmental issues, right? I don't think this is going to last forever. That's just my take.
Yep.
But,
no, I completely agree. Can I throw in a story for this week?
Of course.
Yeah, cool. So I'm, I consume a lot of different media passively, some obviously directly, but I want to shout out sort of the two main industry rags in terms of carbon markets, Quantum Commodity Intelligence and Carbon Pulse. I think that they do an amazing job of covering what is a very niche market, but they do it in a fairly balanced way, very factual and with as little bias as possible. So I want to shout them out. So I'm gonna throw it up to a story that I just read. I think this morning about that was on quantum, and it's that mining giant Rio Tinto is now looking towards basically nature-based solutions, in particular those Australian-based solutions via ACCUs to meet their targets. This is an example, I think, of and Rio Tinto does an amazing job. Their carbon teams and are really, really, really thoughtful and very mature in terms of their approach. But it shows the complexity of large multinationals, industrials, mining, airlines, shipping, steel, cement. I can go on, but there's a lot of hard to abate sectors, and mining metals are one such very difficult one. We need a lot of the products that are coming from mining. I don't want to denigrate it as an industry. It is really important. Everybody likes to have a nice new iPhone. Where do you think the metal comes from? mining, right? Again, we talked about coal. Where does that come from? Mining. Where does all the steel come from, et cetera, et cetera, et cetera. They play a really integral part and heavily woven into the supply chains globally. And it just shows how difficult it is to meet the appetites of the global economy whilst also trying to decarbonize. And I really commend Rio Tinto for actually standing up and effectively demonstrating leadership here by saying essentially that they have a target to reduce Scope 1 and 2 emissions, right, from their operations, which is, I believe, 50% by 2030, if I'm not mistaken, relative, I think it was a 2016, 17, 18 baseline, something like that. But their emissions profile is large. Scope 1 and 2 is like 30-something million tons, right? And they're bringing it down, but to achieve net zero, it's not going to come down as quickly. And I think they're looking and understanding of market-based approaches. They understand that they need to rely on them. And so the way that they do that is by deploying capital into areas that are of importance to them. And so they look at, obviously, Rio Tinto is a global organization, but they have a very heavy footprint in Australia. And so it makes sense that they're supporting the domestic market in the form of ACCUs. And I think that that's a really good sign and a positive one for the market, right? And I think, to echo something that I said before, but I've got friends in consulting and advisory across the board, and they tell me a lot that the clients that they speak with actually finding it really tough and are realizing pretty quickly that in the 2030s, they cannot achieve their targets without the help of carbon credits. And just to final point, assuage the kind of concerns or the guilt tripping that occurs around an over-reliance on carbon credits. It is a market. There is absolutely no risk of over-reliance on the carbon markets. Newsflash, it is not an infinite well of supply. Just to put it out there, I want to dispel that notion that there is a finite limit of emission reductions and removals that are currently available and even forecast on the forward curve in terms of the pipeline for generation. And that our current systems lack the ability for elasticity. So should that demand signal come in, that we won't see the supply being turned on, I should say. It is not a factory where you can just provide the signal, switch it on, and then carbon credits come out the back. We have a very detailed, very significant sort of governance process that takes time. And so, and especially given the recent stories of the last few years criticizing the integrity of carbon credits, you can bet your bottom dollar that the certification standards and bodies take a very deliberate approach around ensuring that what is ultimately issued is of highest integrity and that they have dotted the I's and crossed the T's. So just want to iterate on that point, right? That there cannot be reliance, or there will not be reliance or over-reliance on carbon credits, but they're an essential component of the decarbonization agenda. And we're seeing that in action now, which is great.
Yeah, 100%. I think you hit the nail on the head there. Definitely carbon credits are an essential part of any corporate's climate toolbox, right? And I think with, this past year was the hottest year on record, right? So I think it's essential that, the critics, kind of come to this realization and stop bashing voluntary climate action from good actors, right?
Mm-hmm.
It's really amazing. But with that being said, I think that's a good time to wrap up this week's episode of This Week in Carbon, right? It was a little last minute, but great having Akash and Olaf on the pod, and great having, you as well, sharing your perspectives.
Thanks, Eddie.
And, sharing some of the recent developments in the marketplace. So with that being said, thanks everyone for listening, and comment, subscribe, follow us on LinkedIn, and that's a wrap.
See you next week.
You guys.
Thanks, mate. Bye.